Hey, if you're getting ready to complete your retirement paperwork from the federal government, there's some important decisions that you need to think through. So before you do it, check out this video coming up next. Hey, this is Mel Stubbs. I'm a financial planner at Christy Capital Management, where we're helping federal employees plan for a more successful retirement. If you need individualized help, go to christycapital.com and click Talk to an Advisor. Today we're talking about the decisions that you have to make when you're filling out the paperwork. Now, lots of the paperwork is self-explanatory with your address and your bank account for your direct draft and stuff like that, but there are several decisions that you should think through. The first one is the survivor benefit election. Now, with FERS employees, you have three different survivor benefit options that you can choose from. You could do the 0% survivor benefit, where if something happens to you, federal retiree, your beneficiary would get nothing. We will use the example of the beneficiary being your spouse because that's usually what happens. If you pick no survivor benefit, then your spouse is not going to continue getting a check at your death, but also they will not get the federal health care anymore. There's a tie-in between the FEHB and the survivor benefit. The way the rule states is that to stay on FEHB, the person has to still be on the annuitant rolls. And so for your spouse to be on the annuitant roll, there has to be a survivor benefit left to them. So if you want your spouse to keep health care after you die, that pretty much means the 0% portion of 0% option is not really an option that you can pick. Now, the only way that you could pick 0% is that if both of you, you and your spouse are both federal employees. You could pick a 0% survivor benefit, and if you die, your spouse can stay on the health care because they already are on the annuitant roll because they're a federal retiree as well. Now, the next choice is doing the 50% survivor benefit. This is leaving half of your check. So you get a full check while you live, but at your death, your spouse will get half of your check. Now, this comes at a cost of 10% of your pension. So if you have a $3,000 a month pension, it would cost you $300 a month to pay for this benefit. Now, one of the drawbacks of the survivor benefit is that the price is based on your pension. And so hopefully most years you're going to be getting a cost of living adjustment. So over time, your pension potentially gets higher and higher, and that means the cost of this benefit is going to get higher and higher. Now, if you die and you leave a survivor benefit to your spouse, that means they get a benefit. But if your spouse dies first, another drawback is that you're not allowed to change beneficiaries to anybody else. You don't have to pay for the survivor benefit anymore, but everything that you've paid in all the years past, prior to your spouse dying, you don't get any of that money back. Your spouse is the one and only beneficiary. So if some of these drawbacks, you don't like, you could look at doing the 25% survivor benefit, which is going to cost you 5% of your pension. So in our example, the $3,000 a month pension, that only costs you $150 a month. If you think your spouse needs more benefit, you could take the additional $150 a month that you would have spent to get the 50% survivor benefit, and you can go look at buying life insurance. Now, the right kind of life insurance that you should get to replace the survivor benefit is the kind that lasts forever. You want to make sure that you get a policy where the payment stays the same forever. That way, when you compare the survivor benefit that costs more every year that you get a cost of living improvement, the life insurance would stay the same price. It's one of the benefits of life insurance. You also can change beneficiary to somebody else. So where with the survivor benefit, if your spouse dies first, you don't get to change beneficiaries and all money paid is lost. But with life insurance, you can change the beneficiaries and then somebody, somewhere will get a benefit at your death. So the survivor benefit election is the first big decision to think through. Now, if you're going to go the life insurance route, make sure you get approved first before you check the minimum survivor benefit. Once you've made a survivor benefit election, you cannot change it. So make sure you're already approved, you got the approval in hand, and then pick the survivor benefit election that you want. The second big decision is what to do with your FEHB life insurance. Now, the basic has cost the same price your whole career, but option B, which is up to 5 times your salary, has been going up in price every 5 years. Once you hit age 50, 55, and definitely by 60, it's getting really expensive. And at retirement, the basic gets a lot more expensive. So if you need life insurance and your health is good enough, you may want to look at getting an outside policy for the amount that you need. That'll be at a price that stays the same. If you get a term policy, the price stays the same the entire term. So maybe you get a 15-year policy, that means the price stays the same for 15 years. Now in year 16, you won't have any coverage. So you need to make sure that your plan works well even in year 16 if you don't have any coverage. If you get the type of life insurance that lasts forever, then the price will stay the same. That's a benefit over how FEHB works. You're able to reduce your FEHB or cancel your FEHB anytime. And a lot of times in retirement, people choose the 75% reduction option for your basic, which means that you continue to pay the same premium you've always paid up until your 65th birthday for the basic. And then at 65, it becomes free, but your benefit starts dropping 2% per month until 75% of it has gone away. And so you'll get 25% of your final salary for free in retirement. That's choosing the 75% reduction. If you choose the 50% reduction or you leave it at full strength, it gets a lot more expensive in retirement. So that's something you may want to think through before you fill out your paperwork. Another decision to have that's not really in the paperwork, but it's something that you'll want to figure out is that retirement, what are you going to do with your TSP? At age 59 and a half or at retirement, no matter what age you are, you have the ability to move your TSP out to an IRA. And for the people that want to move to an IRA, here are the main reasons that they want to do so. You've got more investment options available than what you do in the TSP. Now the TSP has added a mutual fund window, but it's very cumbersome to use and the fees are a lot higher. Other people will want to move out because they want to work with somebody that understands the financial planning and understands their FERS retirement system. They won't help. Most people can do their own retirement planning, but not everybody wants to. Not everybody's good at it. Not everybody has time to do it. And so if you want help, you can move your money out to an IRA and receive that help. If you're okay with a little shameless plug, that's what we like to do. We help federal employees and federal retirees manage their money. So if you're looking for someone to help you, look no further. Go to christycapital.com and click Talk to an Advisor. We'd love to talk to you. Another thing that the TSP doesn't let you do is Roth conversions. If you've watched any of our videos, hopefully you've seen some Roth conversion videos. This is taking traditional money and moving it to Roth year by year, playing the tax bracket game, where you move enough to make a difference, but not so much that you go way up in the tax brackets. This type of planning is not available in employer-sponsored plans like the TSP. It's just not something that they do. If you want to do that, you have to move the money out of the TSP. Now, some special mentions here is that if you are special provisions, or if you retire, maybe right at your MRA, or you're under the age of 59 and a half, you will want to leave some money still in the TSP. The TSP does have the benefit of letting you take distributions without the 10% penalty. So in an IRA, there'd be a 10% penalty if you were under the age of 59 and a half. In those cases, people are usually moving the majority of their money out to get the different benefits that we talked about, but they're leaving some money back in the TSP in case they need to take a distribution. Well, hopefully some of these items will help you in getting ready to fill out your paperwork. If you want to see more about how to do a TSP transfer, check out this video right here about TSP withdrawals in retirement. It walks you through going on the TSP website and doing a transfer out into an IRA. My name is Mel Stubbs. Please let us know how we can help.